Hi, Mark Anderson here, mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to earn your business. Please do call or text me at the number below anytime, for any reason, but hopefully to talk about either a purchase or a refinance mortgage scenario. I would be happy to talk to you. So for today's mortgage rate update, before I go into what happened in the market today and where things stand as far as rates go today, I wanted to sharpen up the point that I made in my video yesterday just a little bit. It was a long one. I was kind of thinking on the fly, trying to collect my thoughts to make the basic argument that I don't see a reason from a fundamentals standpoint, based on what I know now, which by definition does not include things that could happen tomorrow. But I was playing around with this notion that if the economy gets worse, will that cause interest rates to go lower than where they are now? The basic argument is we have already seen the phenomenon of the flight of money from stocks into bonds, which caused the rates to drop initially back in early March. We've already seen that process take place. What happened after that is that money actually flew out of bonds. And that is why the Federal Reserve came in at that point as a backstop to build liquidity into the mortgage-backed securities market. So my argument is actually relatively simple. It is that if the economy continues to get worse, what that's going to be characterized by are things that are not, in my opinion, going to lead the big mortgage investors to sweeten up their pricing. These mortgage servicing institutions are going to be facing defaults, slow payments, forbearances, etc. And I do not see additional job losses or people being behind on their mortgage payments. I don't see those things leading to mortgage servicers actually decreasing their profit margins on new loans coming into the system. The extra layer of risk there is the fact that this market right now is supported by massive cash infusions from the Federal Reserve. There is a danger that as the Federal Reserve slows or maybe even stops funding the mortgage bond market, that we're going to be back to the place that we were. There were a couple times in March where pricing actually got really bad after the initial drops. And I think that overall, from a risk standpoint, I just don't see a reason to expect or to believe that the rates are going to be significantly lower than they are now. Now, day to day, and the reason I'm going to continue shooting these videos day to day is that pricing is going to get worse, it's going to get better. It's going to get worse again, it's going to get better. Rates are cyclical. That's what they do. And so there are going to be variations in rates day to day for any number of reasons. And I'm here to track that and to keep people apprised of what's going on with that. But the point I was making was a broader point, that if you're waiting on the fence for significantly better rates, I have yet to see an argument that suggests that that's going to happen. Now, I did get an interesting comment from one of my viewers yesterday that suggested, conversely, if the economy gets better, people do return back to work. Could that then therefore lead the servicers to think, well, we were bracing for impact and the impact is not as bad as we thought? Maybe at that point, they will actually decrease their profit margins, bring those back down toward, I guess, what we'll call normal levels. And then at that point in time, maybe the pricing would improve. However, that would presuppose that we're still going to see bond prices in the range that we're seeing them in right now. And I think that if the economy gets better, there is a greater chance that the Federal Reserve at that point will either slow or stop this bond purchasing program. The underlying fundamentals of what this mortgage bond market would look like without the Federal Reserve, in my opinion, I think that we would see lower bond prices. And I feel pretty strongly about that. But in this crazy situation, anything can happen. So back to today's mortgage rate update. What we saw is today was a good day to lock. And I did advise several of my clients that now was the time to lock. We saw what I would describe as marginally better pricing than yesterday. That said, even though we have seen the bond prices come up today, yesterday we closed at this 103.69 level. This morning we saw some improvements in the bond prices that actually, and this is uncommon, they were relatively sustained throughout the day. So we saw the sustained better bond price levels. We saw marginal improvement in pricing. And so it did represent, in my opinion, a very favorable time to lock. Now, I do not believe that just because we're seeing bond prices closer to the 104 level, that that's indicative that we're going to see continual improvements in the bond prices. Again, this is a very artificial market. It's driven by the Fed's involvement in it. And so for me, I would rather lock at a time where we seem to be in a good window than wait around for the potential based on no real data suggesting that bond prices are going to be getting significantly better. I would rather lock in when we know rates are better than they were yesterday than wait for something better tomorrow. I think that's the safe bet to make. So bond prices, again, today, we're almost at those 104 levels that we saw last week and the end of the week prior to that. It will be very interesting, of course, to see where these go. But one thing to remind everybody about, even when the bond prices shot above that 104 level, we at that time did not see the mortgage investors out there clamoring to reduce their profit margins and to lower their interest rates. They're very quick to increase their rates at the first sign of trouble. When the Fed turns off that tap, they're very quick to make their rates worse than they were at the beginning of the day. They are not so quick at all to make their pricing better. So that's what's going on today. It's a little bit of a short update. I am interested to see how this plays out. Please do like the video, subscribe to the channel, share the video, and please do add comments. I really want to get a conversation going. The comment I got yesterday regarding that scenario about the economy getting better, it really made me think. I want that level of engagement. As part of the reason why I'm doing this is I want to hear from people. So again, thank you for watching, and I'd be happy to talk to you anytime. Have a great day.